Hello, I'm David Chaston with 90 at 9, brought to you by Interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock with news that is turning sour almost everywhere. Equity markets shifted gear lower at the end of last week. On Friday on Wall Street, the S&P 500 dropped a sharp 1.9%, wiping out more than a tenth of the 2019 gains. And that followed Europe, which was down a similar amount. In fact, London fell more than 2%. And this was even though Asian equity markets closed largely unchanged on Friday. Driving the rout has been very weak factory data for March. The Eurozone flash manufacturing PMI dropped sharply, down 1.7 points from an index that was already showing a contraction. It's now at a 6-year low. In the US, the same survey dropped as well, even if it's still indicating an expansion in American factories. But it is weakening fast. The output, new orders and employment components all weakened. After Japanese markets closed, the Japan PMI came in worse. Factory output fell at its fastest pace in 3 years, and the sector is now contracting there. But before we all jump off the nearest ledge, we should also report that the services sectors in the US and Europe are still expanding, but the rate of expansion is slowing as well. Not only are equities dropping, bond yields are as well. And a key rate curve inversion, the 1 to 5 US Treasury curve, suddenly grew. And the spread between the 3-month Treasury bills and 10-year note yields inverted for the first time since 2007. It's the second inversion that has investors in a double take. Not helping the mood, the US federal government posted its widest monthly deficit on record in February at $234 billion for the month, amid falling corporate and individual tax revenue and increased federal spending. That was 9% more than the same month a year ago and exceeds the record set in 2012. Not all the news is bad in the US, however. Home sales jumped almost 12% in February on a seasonally adjusted basis from the previous month. However, they're still down 2% from the same month a year ago. And China is applying the screws to Canada in an effort to bully it over Huawei. It is stopping all canola imports and slow-tracking import procedures for most other agricultural products from Canada. The US Treasury 10-year yield has fallen sharply and is now at 2.44%. Their 2-10 curve is narrower at just 12 basis points, while their 1-5 curve is negative and blown out to minus 21 basis points. Gold is firm, up to $1,313 an ounce, which is also a gain over the past week. US oil prices are falling, and quite sharply. They're down more than $1 and now at $59 a barrel, while the Brent benchmark is down to just on $67 a barrel. And the Kiwi dollar is at 68.8 US cents. On the cross rates, we're marginally firm at 97.1 Aussie cents. And against the euro, we're up to 60.8 euro cents. That puts the TWI at 73.3. I'm David Chaston. That was 90 at 9, brought to you by Interest.co.nz.